Good morning, dear students. In continuation of the working capital management portion, we had already dealt with, in the last fourth video of working capital management, we had already dealt with various policies adopted by the working organization, various financial policies adopted by the organization for managing the working capital. It may be conservative, aggressive, and moderate policy or average policy. Based on that, we had done problem. There are few more portions left in the working capital management. Most of the portions which are left are having importance for theoretical portion according to our syllabus. But still some portions are left in the chapters like receivables management, cash management, inventory management, which I will be dealing in the continuation of working capital management videos. So in this fifth video of working capital management, I will explain about theoretical portion of receivables management, what you have to concentrate more. Receivables management is all about how to get the money from the debtors or how to manage the receivables. You could see this chart inside the textbook. There will be receivables credit policy for the organization. The amount, what do you mean by receivables? The amount to be received from debtors is receivables. We have studied bills receivable. It's a part of receivables management. So if the credit policy, if you look into the graph, there is something like credit policy in the x-axis and cost and return or benefit in the y-axis. You could see here the credit policy. If we are stringent, tight credit policy is there, the cost and the return percentage will be very high. Because why? The people will pay back the amount fast because of the stringent policy. You could see that this policy is adopted in some banks, especially private sector banks. When we take loans, they will remind, for them it is receivable, for the banks it is receivables. They will remind us with the tight policies by giving periodic intimation to pay off the loan. The return will be fast. But in case of business, you see, more liberal policy, the liquidity will be less because the people may take more time to repay the amount. So the debtors lag will be there. So credit policy, determination of the optimum credit policy is what we are studying under the receivables management. Optimum investments in receivables. See, there are two things which you have to understand here in this graph. We will be in a business, we will be making credit purchases and credit sales. Receivables management deals with the credit sales, how we are going to deal with, not about the payment part. Okay, the credit policy, it is the term credit is mentioned on behalf of the debtors policy, not on behalf of creditors aspects of payment. So if we give more time for debtors, what will happen? Liberal credit policy, the liquidity will be less because the conversion of debtors into cash or receivables, it will take time. So this is what it is explained in the graph. I will send the photocopies of these pages now to understand what is more about the receivables management. As you had looked into the textbook graph, the same thing I had given here. The organization have to always check what is the optimum credit policy for the organization, whether it is stringent credit policy or loosened or liberal credit policy. In such case, in case of stringent credit policy, what will be the cost? Case of liberal policy, what will be the cost? Liberal policy, the cost will be less. Cost of credit expenses will be less, and it is in between that profitability and liquidity decision is being made in under the receivables management. What are the things which we look into for the receivables management? What are the variables of credit policy is the next one. From the debtors angle, it's all from the debtors angle, or which is which is arising from the credit sales. An organization having credit sales, usually they will have debtors. What are the things which we want to look into before providing to a particular party or organization to sell the goods on credit? All the C's mentioned below we have to look into. What are those C's? credit standards and credit analysis should be made. Now, what period, till what term you will be providing credit to the debtors. It should have a match with the payment side also, because from the suppliers to the suppliers we have to make payment for credit purchases. It should be met, or the organization usually make that credit payment on the basis of the amount received from the debtors or collection from the debtors. So that is what it meant. What is meant that credit standards and credit analysis. Credit analysis is a technical part. Credit analysis is done through various mathematical and statistical tools like numerical credit scoring, simple discriminant analysis, multiple discriminant analysis, and one more thing is the ad hoc approach methods are there. Now, these are various methods to analyze how much credit period should be given to the debtors. For example, you could see inside the textbook, ad hoc approach. What is this ad hoc approach? Ad hoc approach is that when we take a client in order to provide him sales credit, we will look into what are the facilities, what is the credit stability of the debtor to pay our amount due. For that, we will check whether he is employed. If it is employed, whether it is self-employed or he is unemployed. What is his income position? What is his bank account position? Okay, what is his residential status, residence? Whether he have residential status here, not in the way of taxation, not from the angle of taxation. Residential status is here whether he have own house or rented house. Well, his marital status, whether he is married or unmarried. Unmarried people will be having more obligations. Okay, and residential status on owned house is different from rented house. Rented house, he have to pay rent, so he have more obligations. Okay, age, more aged people will be having more obligations, and financial obligations will be there. And his integrity, whether his character is excellent, good, fair or bad, all these things we will take into consideration. This I am talking about a particular person's capacity will be measured based on the credit stability he have, based on his bank account, resident, marital status, etc. We will point, we will give a score. That is one of the methods used, which is called as ad hoc approach. Sometimes discriminant analysis will be made. There is something called simple discriminant analysis and multiple discriminant analysis. There is taking one or two factors we will determine. For example, you could see here that two factors are taken into consideration: earnings before interest and tax and operating cash flow, and we will compare it with sales. Okay, earnings before interest and tax to sales and operating cash flow to sales. We will take into consideration from various customers' angle, from whom we have to get money. We will mark the position. We will chart out. It is called as simple discriminant analysis. That is only two factors rather than in ad hoc approach taking all general factors. Here the organization is taking into consideration only two factors. What is it? EBITDA, earnings before interest and tax, and OCF, operating cash flow, and comparing it with sales and mark. Okay, mark inside the graph. It is called a simple discriminant analysis. There is something called multiple discriminant analysis. When there are various factors which we have to look into before providing credit terms to the debtors, it is called as multiple discriminant analysis. There is something called Altman's Z score we apply in multiple discriminant analysis. What is this Altman Z score? See here, from the name itself it is called multiple discriminant analysis. Multiple discriminant factors are there. What are those factors? Here we are taking into consideration net working capital to total assets, retained earnings to total assets, earnings before interest and tax to sales, market value of equity to market value of equity to book value of debt, sales to sales to total assets, etc. In the sense, various factors were taken into consideration. What is it? Net working capital, total assets, return on retained earnings, earnings before interest and tax, market value of equity, okay, and total assets. All these factors are taken into consideration. One model is under multiple discriminant analysis. One model is Z score or Altman's Z score. Okay, there is an equation which is given. Z is equal to 0.012 into this variable or this value is fixed in the Altman's Z score. And I will repeat once more. Z is equal to 0.012 into net working capital divided by total assets plus 0.014 into return on 0.014 into retained earnings divided by total assets plus 0.033 into earnings before interest and tax divided by sales plus 0.006 into market value of equity divided by book value of debt plus 0.010 into sales divided by total assets. We will get a score. The score value, there is some cutoff given under the Z-man score. Altman's Z-man score established a cutoff score of 2.675 is the cutoff score. If the firm is, after this calculation, if the firm is having more than 2.675 score, firm is having more than 2.675, it is assumed as financially strong firms. So a company, for example, if we are running a company, we will analyze the multiple discriminant analysis using, we will do the multiple discriminant analysis using Altman's Z score and check the score. Whether it is above 2.675, it is a good firm. So that we could give, definitely we could provide credit to that organization, or we could provide more time for the organization, or we could fix the time because of based on the good financial stability or score they have. If it is low, if we are having lower score, it indicates that it's financially low, financially having lower strength to repay our debts. So sometimes we may reject. So it's based on this score, an organization will determine whether to provide debtors credit time more or not. You could see that in the question, the informations will be given directly. That is net working capital to total assets, return on retained earnings to total assets, earnings before interest and tax to total sales, then market value of equity to debt, it will be given, sales to total assets will be given, and you have to simply calculate that formula. Using the Altman's Z score, we will decide whether the firm X or firm Y is having better financial stability. Under this problem, firm X is having more financial stability, hence it is more than, you could see here, it is more than 2.675. So it's a cutoff score of X is having higher score, and the firm may be extended credit, give an extended credit, while firm Y is having 1.859 only, it can deny the credit. Okay, so that is what we are studying under the receivables management, one of the problems. I will scan this page and send it to you separately in order to do this problem. It is I.M. Pandey textbook, page number 855, describes about Altman's Z score, which is very important from the receivables management angle. And another important thing is that all other aspects in credit receivables management are the credit evaluation, how we do. It's based on the credit standards and credit analysis. Credit terms and credit period should be checked into. Collection policy and procedures should be checked into. And these 5 C's you should be taken into consideration before granting credit to the debtors. What are those 5 things? character, capacity, condition, credit worthiness, and cash discount aspects should be taken into consideration. Similarly, credit information, you should be aware. Credit investigation should be done. Credit limits should be fixed. Collection procedures and efforts are also very important. So these are the things which we have to focus on. Receivables management as a part of working capital management module. So thank you. In the next video of working capital management, I will be dealing with inventory management. Thank you.